What's up, guys? This is Bobby with Growth View here with you again today. And our guest is Morgan Hampel. He's with the U.S. Navy, and he's an assistant professor of naval science. And he's got a pretty incredible real estate background I wanted to share with you guys and let him tell his story. But what's up, man? How's it going?
Great, Bob. Appreciate you guys having me on today. Yeah, like you were saying, so full-time job is with the Navy. My background within the Navy is a nuclear surface warfare officer. So done a tour on a destroyer, got some nuclear power training out in Charleston, and then did a tour on the USS Abraham Lincoln as one of the division officers in charge of running and operating the reactor plant down there. From there, and like you said, now I'm an assistant professor of naval science over at the University of San Diego, helping teach ROTC. But ever since about 2017, I've been investing in real estate, starting out in single family, doing a small single family home. I got a condo, did a small multifamily, did a 3-unit, but then realized for my long-term goals of eventually, by the time I got out of the Navy, whether it be 5 years, 10 years, or 20 years, my goal was always to build enough passive income where I wouldn't feel the pressure to get a regular 9-to-5 job. And at the rate I was going, I didn't see that actually coming to fruition. So I got into syndications. And so after I did those, my next deal was 68 units. And then actually we just closed on 106 units about 3 weeks ago. So jumped into syndications, and now that's hopefully going to be my my ticket out of active duty the next few years, and won't have to feel the pressure to get one of those regular jobs.
Nice. Well, incredible work, man. Congrats on the recent 106 units. That's awesome.
Thank you.
Well, yeah, thanks for the background introduction. And winning deals during COVID, and even if COVID wasn't here, just with like low rates and just the monetary expansion, like it's a crazy market. Like, what have been some things that you've done to help you win these deals during the last year?
Well, one of the biggest things that my business partner and I have really done to try to set ourselves apart is establishing personal relationships with the brokers that in the markets that we're in. So right off the bat, when we were doing our market research, we determined what our top 3 markets were, where we wanted to actually go in, start analyzing deals, underwriting, and putting in offers. And since we're just starting out, we're not the ones at the time calling individual owners, looking them and trying to convince them to sell. We're doing more so of just getting our leads from brokers directly. So when we determined what markets we wanted to be in, the next thing we did was actually go in and meet pretty much all the brokers that I had been in touch with via email and on the phone. And one of the things that we were doing were, I call it like almost like a cash cab style type meeting. Vice, the normal like coffee or lunch meeting, what we were doing was getting actually in their car and asking them to drive us around. And so what was nice about that, because one, I can analyze a market. I can read all the, the Marcus Millage app, the CBRE reports and whatnot. You can get a very objective view of a market and where you think it's trending. But another aspect that's very important is understanding kind of the subjective side. And you really get that when you get to know a broker and why they are working in the market that they're working in, because a lot of them, they're not even, they're not from there, but they moved there for a specific reason and they're in commercial real estate. So we're getting that view, but then also while we're driving around, we're looking at all the sub markets within the major market. We're able to identify not only, hey, do I want to be in Des Moines? Those are where my 68, 160 units are. But we want to be in this specific pocket. This is the type of product we're looking for. And we're having that active conversation as he's pointing out, or he or she are pointing out, hey, this person sold this deal, it went for this per door. This was the buyer, and you're kind of getting a better feel on like who you're competing with, and then what you need to do in order to position yourself accordingly for these deals. So getting to know them personally has been huge. And they see us, they say like, hey, these guys aren't just like another guy hitting me up on LoopNet, but they actually, they need business. So that helped a ton. And then when it came to, the nuts and bolts when we're writing our offers, things that helped us a lot were saying, our earnest money is going to go hard after, due diligence, or at some point in time during due diligence that shows that, it's a competitive offer. It's almost pretty much standard now, but something that we made sure to do. And then also when we're submitting the offer, putting in little bio sheets, because a lot of people, a lot of these owners, especially in the tertiary markets that we're in, are, mom and pop owners. The complex has been in the family for, 20, 30 years, maybe more. That's what it was for the 106 unit. The father-in-law built it in 1990, sold it to the son-in-law. So there's a lot of sentimental value. And what comes with that is when you get rid of it, putting in something that, giving it to somebody, with a face, not just an institution, right? And I think that kind of helped us out here, because this was when we won the 106 unit contract. It was, I think, 5 or 6 offers on the table, right? And so seeing our faces that we submitted with our offer, our bios, our intentions for the property, kind of laid out the business plan for them, not just like, hey, here's the sticker price that you're asking for. I think it, did a lot for us, especially being new guys. We had to position ourselves a little bit different than some of the larger players.
Nice. Yeah, there's some good key points there. And you mentioned like riding around with brokers and meeting them individually. Like, it's funny that whenever you, like we said, we have 2 ears, 1 mouth. When you really listen to people, like, these brokers may be saying things that are just no brainer common knowledge to them, but you as an investor, when you hear it, you're like, that's very key information for this market or this deal. So that's a big takeaway. And then the kind of like the intimate story behind like your offer versus other people. They like knowing it's like a good-hearted person and you're putting in extra effort. A lot of people, they're just like sending out offers and not really taking the time to build a relationship, and that's clearly paid off for you. So that's awesome.
Yeah, no, absolutely. And plus, like, when we, like, the main thing that we get out of those drive arounds, obviously you learn about the market, but you really understand what type of product you're looking for. Because it's so, like, I'm sure, as you know, like when you sign up and you meet with all these brokers, your inbox just gets flooded with all these like, hey, this is for sale, this is for sale, this is for sale, this is for sale. And they get really watered down, and you honestly, like, you almost get a inherent bias thinking that this won't be a deal, right? Because it's not specific to, you, what you want. It's just specific to you because you're a buyer. So what we're able to do is narrow down what we consider our criteria. So we're getting the broker is actually doing some of the filtering for us by sending us everything that's on the market. And then when we do get, a good lead from, a broker, it's something that they vetted, they know what our criteria is, they think it's in our criteria. Now, do we agree? So, and we, we've analyzed a ton of deals, and, the 2 offers that we submitted actually put LOIs down were 2 that got picked up. So we were 2 for 2 on those. And a lot of that comes from, one, how stringent our criteria was, but then also the relationship we knew with our broker to send us, hey, this is our criteria. And then they sent us stuff that actually met that criteria, and we agreed.
Yeah, awesome. So yeah, you mentioned you shifted from like a single family and doing maybe like 3 to 4 units into like multifamily and syndicating. Like, what have you been doing that's been effective for you to meet new investors, raise capital, and just keep your investors informed in between deals? It's been powerful for you.
I mean, a lot of this, like right now, especially at the size where we're at, all of our fundraising has been the 506B realm, which is, it's the kind of the friends and family raise, like they call it. So I can't do social media marketing. I can't do it. So all the people that we bring in to invest in our syndications are people that we know. So the best thing when it comes to maintaining relationships is just, talking like this. And I mean, granted, not everything's via podcast, but like anytime you're going out for coffee or drinks, you meet up with friends, like my friends have kind of like known me as being, the real estate guy now. And I'll have, friends of friends, family of friends, friends of family, and so on, reach out to me just with random questions. And then I'll answer their questions, and I'll just drop it in like, hey, by the way, like, this is what I'm up to. Like, do you have any interest in something like this? Or, and most of the time they do, just because there really aren't a lot of syndicators out in I mean, when you're in the syndicator circle, it seems like everybody is, but like in the grand scheme of things, there's really not many people doing what we do. So people find it really, really interesting. And then like on our first deal, we raised $1 million, and that was from 20 investors, all of which we've known everybody for years. And then on the 160 unit, we raised 2 million, and those were everybody we've known for years as well, plus 1 degree of freedom, maybe 2 degrees of freedom through just conversations on how that first deal went, right? So I can't be right now with 506B, I can't be the Grant Cardone and just putting out a ton of content for an active deal that I have, but I can put out a lot of content, and just like myself and maintaining our contact list and just calling people and telling catching up with them and telling them what I've been up to, and then they do a lot of the marketing on my behalf when they believe I'm a good, ethical, and smart business person.
Yeah, well, clearly you've been doing a great job, and hopefully this video helps you get that reach further.
I appreciate the help.
Yeah. Well, awesome. And tell me a little bit about the role and like what the military has taught you about real estate. And obviously, Brad Penley, one of the partners at Growth View, he helped kind of make the introduction, and you've known him for a little bit. So maybe just speak on your and Brad's relationship and how the military's made an impact on you guys.
Well, I met Brad through a similar thing that we were just talking about, just through talking with people and saying, hey, I got another buddy who does syndications. And it was fun, actually. So it was a realtor I know who was a prior surface warfare officer, huge real estate agent in the residential here, who introduced me to Brad. We met up and kind of started realize that our goals were aligning when it came to syndications, both still active duty, and definitely have traded lots of best practices together. Phenomenal guy. But one of the things that we talked about, especially still being active duty, one thing that's kind of stuck out to me to kind of help guide me is I finished reading a book not too long ago, Outliers by Malcolm Gladwell, and they talk about the 3 things you need for a rewarding, meaningful career, but then also life is human connections, a challenging environment, and autonomy, right? And the Navy obviously provides those first 2, the human connections and challenging environment, but they're not so much of the autonomy. And that book, we wouldn't have given that same kind of impact to me as it did, especially that one segment really meant a lot, especially going through multiple deployments. And I've never been somebody to shy away from work, but it's been losing control of your time when I'm trying to go to a wedding, or go to have to go to a funeral, or want to be there for my nephew's football game, like all those things that you kind of lose. Granted, in service to my country, which I love and I wouldn't have traded a day for, but you don't really get the grasp of what your true goals are until a lot of it's stripped away from you, right? So that's something that you don't really expect to learn, because it's not what the military provided, it's what it didn't provide, but then also on a more, on another tangible level, it's you see all these great leaders in the military, and there's just as many bad ones too. And learning the difference between working for time or working for tasks, working efficiently, because we've all worked for somebody who we have working hours regardless of how late you work, how much work you have. You will work until this time, but what if I'm better at managing my time better than you? Then are you still just going to keep me here to keep me here, right? And a lot of that ties out into this stuff too, because especially with my business partner and I building out our business, now we have full autonomy over what we need to get done coming forward, and all the lessons that that I've learned through multiple deployments and working for phenomenal leaders, and also some not so good ones as well.
Absolutely. Nice. And you mentioned both of your properties there in Des Moines, Iowa, is that right?
Yeah, so one's Ankeny, which is a suburb just north of Des Moines, and then one is just about in Des Moines, a mile south of the downtown area.
Nice. And what made you, I guess, the next question is like, what markets are you interested in, and what made you pick Des Moines out of just, everything out there? There's a lot of really overly hot markets right now, and ones that have been hot for a while, but that's definitely not the typical area of focus.
Yeah, no, absolutely. Absolutely. So when we first decided to jump into syndications, first thing we did was market research. And we determined what like our key criteria was going to be. So we were looking at job growth, we're looking at population growth, we're looking at job diversity, we're looking at median age, and we're looking at job diversity, yeah, job distribution, right? And the top 3 markets that we found from pulling, and I was manually scraping census data to kind of come up with my own numbers, and then compare them to those, those major CBRE reports just to see how they stacked up. And the top 3 markets that we found were, number 1 was Salt Lake City, number 2 was Boise, and number 3 was Des Moines. So the that Sun Belt, Salt Lake City, Boise, that's been blowing up now for probably 5, maybe 7 years. And you're seeing that too with the USPS migration data. You're seeing it with the U-Haul migration data, which is another interesting stat to go look at. You can see where people are picking up U-Hauls and then dropping them off for moving. And those cities are growing at an exponential rate. The only thing that's prohibiting Boise right now is just their ability to build the infrastructure, but they're skyrocketing, right? So when we first flew out to Salt Lake City to do our cash cab drive-throughs, we were seeing that, but then with that comes a lot of those bigger players, and properties are trading at 4 cap, maybe 4.2, maybe even sub 4, especially right now. And when it comes to where our comfort level was, even if we won a deal, there's not much meat on the bone there. So then took a step back. Next up was Des Moines, and I actually have familiarity with the market already because I went to school. I got my bachelor's and master's at Iowa State, which is just north of Des Moines, and we started looking back into that, and there's a ton of growth going there. We're hoping that if Salt Lake City, Boise are 5 years behind the Denver, Seattle right now, well then maybe Des Moines, Kansas City, kind of those Midwest cities are about 5 years behind those, and maybe we're getting in right now before the secret's out. And when you look at other players that are coming in, Facebook, Microsoft, Amazon, Apple are all building multi-billion-dollar data centers within 15-20 minutes of Des Moines right now, actively right now. And those are some key alpha. Those are some key players too. And then another thing too is outside of Hartford, Connecticut, Des Moines is the #1 insurance hub in the country.
Oh, wow.
And those are huge. There's a ton of money in insurance, as you know, obviously. So we have our major, Fortune 100 companies coming in with data centers, bringing a ton of jobs. You have agriculture, you have insurance, and the other major jobs were health and government. So when you look back, so then we start diving, pulling the next layer of this onion in. When you looked at 2008, the crash, the Iowa market didn't really have a major drop off like some of the more exposed markets did. It definitely hit a stagnation, like it wasn't growing, but you did not see that huge tumble like in some of the other markets. And you saw that again in 2020. So those jobs that they do have are a lot more stable. And granted, you're not going to see the growth that you'll see in Austin or in Dallas, but you're seeing strong, steady growth, and it might be even more stable growth. It's just not as steep. So then start looking at what properties what they're trading at, and because it's a little bit more of a hidden gem, properties are trading at 6% caps, 6.5%. The ones that are really poorly managed, you're getting, they're poorly managed, and all it takes is property, good property management, getting better lease structure, and with minimal capex, you're getting it operating, at a 7 cap and maybe 7.5, and then the trading, you can trade it back down, squeeze it down to 6 on the sale. So I mean, there's a lot more room for us, for air being, being new guys, and there's not major institutional players compressing cap rates, at that 4 sub 4 level that you'll see in some of those larger markets.
Yeah. Yeah, that's I like what you said about the data centers. Like that's a huge area of where there's solid investments I've seen in some of the syndicators I've been chatting with. And that's cool. Like you have a good pulse on what's going on there. Insurance, the data centers, and being a few years ahead, I agree. Like that's awesome, man. That was some good info there. I think people are really gonna appreciate. Now that kind of looking 5 years into the future, that kind of shifts like my mind into a couple of other things. You and I kind of spoke about this before, like the wealth tax that's potentially, coming under Biden's administration, the yields on the 20 and 30-year changing, and like home prices, just all these things adding up. Like I was looking this morning, I think in November, the average home in America was 316 for the median. In December, it's 320. They're projecting into the year in 2022, it's going to be about 360 or so. So like homes are not slowing down. There's a shortage of homes. So there's going to be a big demand for affordable housing. And one thing that's happening definitely right now is a lot of these like commercial leases that people maybe signed like a year, 2, 3 years ago, they're probably in like longer contracts. Maybe these employers are coming to an end where they're saying, hey, we're not going to re-up on these buildings. We're going to give home stipends. People can work from home. They're going to move to more affordable areas. Like, what is your lens on just all of that holistically and the impact it's going to have on our industry?
There's a ton of compounding variables here. One, we have the ongoing labor shortage, both, people just, the great resignation is what they're calling it now. The great resignation, we had a record high. It was like 4.5 million people resigned from their job this month, which was a record, or last month. You have supply chain issues. We have inflation from post-COVID stimulation, cash printing and pumping out, right? We actually had, I was reading this article that came out today that we saw the largest single 10-year treasury bump in the last 20 years today is when it happened. So we ended 2021 at 1.51% and we hit 1.71% today. That's coming off the heels of, mid-COVID, when we had the floor of about, it was like 0.5% or so, like right in March, right when the lockdowns first hit. So, it's going to be interesting to see, because obviously when you have the rising 10-year treasuries, that's oftentimes the kind of the baseline that most banks will lend on their commercial and business loans off of. So when you raise it, especially that steeply, it'll be interesting to see if it gets above 2%. If so, how far above 2%? Is it going to approach 3%? Because now you're looking at interest rates from, the early 2000s. That's really going to stifle the inflation, but it's also going to stifle, growth too, because people aren't going to be able to spend as much, because purchase power is not going to go as far, and the ability to actually lend and take out loans is not going to go as far. So, the bottom line is that money is still going to be circulating, and that's what drives growth. Granted, yes, like 2% bonds, 3% bonds, those are higher than they are right now, but historically that's still incredibly low. It's going to impact what players enter the game, but I don't think it'll prohibit growth overall, because in the end, like you're saying, we still do have a major shortage. Like I know just here in like the San Diego market, I think our housing shortage is in the tens of thousands of units, and people need places to live. What will be interesting to see is that, maybe the conversion of, commercial business to more residential, or if they're going to people start repurposing those, plus of the mixture of remote work. I find it hard to see the real estate market maybe going up as fast as it has been, but I don't think we're at a point where it would actually turn around and start going down. There's just too big of a shortage, just too much demand. Money's going to be more expensive, so it's going to stifle growth, but I don't think it's going to stop it altogether. So I'm still pretty overall bullish, And plus, actually, another thing that I saw this last year, we had a record number of net apartment units rented. So from people moving out and people moving in, there was a net 500,000 units filled through, it was like, I think it's like through the third quarter of 2021. And that was like the single highest through that point ever. And that was only through 3 quarters. That would include the fourth quarter, right? So maybe that shift continues towards apartment complexes and syndicators like us, which is obviously great news for us, and away from, you know, the single family homes, small multifamily, because you don't have to take out a mortgage in order to rent. So maybe it's easier barrier to entry for all these, you know, new Gen Z guys coming into their own place for the first time. So it'll be interesting. Actually, you know, now I'm kind of thinking out loud here. It'll be interesting to see, you know, what spread of, you know, renters versus home buyers, how that shifts. We got millennials getting, you know, now we're, you know, 5-10 years into our jobs, and then you have Gen Z actually getting out of college and going to be renting. But how long are they going to be renting for? Odds are they're going to be renting for a little bit longer than millennials, just because they're not going to have the, you know, ground level interest rates that we did. Granted, it'd probably still be pretty low, but how low? How often is the Fed going to raise the interest rate? You know, supposedly it's going to be 3 times this year, but inflation's going to have a lot of impact on that. It could be more if it doesn't curtail it. So
Yeah,
a lot of compounding things.
That's true. Yeah, good point. Like the millennials have a 5-year head start in the workforce. We're also the biggest cohort, I believe, of home buyers ever. And then Gen Z, when you look at the statistics, and I know it might not be 100% representative, but a lot of the kids want to be influencers or YouTube personalities. You know, they're not like saying, I want to be a mathematician or an engineer, you know?
Yeah, they got different role models.
It'll be really interesting to see how the next decade unfolds. Those are some really good points. Well, cool, man. Well, what does the next year look like for you guys? What are some of y'all's goals? And just tell us a little bit about what 2022 is going to be like for your team.
Yeah, so the goal right now, so we did a goal last year was 150 doors, which we hit 174. This year, the goal is going to be 300 doors. We want to expand into another market, not because we're any less bullish on Des Moines, but just for the sake of, you know, diversifying across multiple MSAs. So we're looking in Austin, we're looking in Kansas City, we're looking at Omaha as potential options. And then we're going to be doing the same thing that we did with Des Moines, you know, flying out there, meeting brokers, cash cab style, interviews, let them know us. And then goals to do, 300 doors. So it'll probably be, you know, 200 to 300 plus unit deals. You know, make some partnerships potentially. We did both the 68 and 160 unit ourselves, and managing the assets takes a lot of time. So looking for, you know, bringing on potential partners to kind of help with the asset management side of things, where, you know, right now we're good at underwriting deals, we're good at analyzing deals, we're good at raising capital. And so if we can bring on, you know, maybe somebody to help with the asset management side of things, that'll free up time to, you know, continue to pursue new markets, pursue new deals. But yeah, the goal, 300 doors this year, and then 450 the following year. And if we can do that, then, you know, July 2024 is my end of my orders, and I might be able to, you know, wave by, roll into the reserves, and then go from there. So we'll see. Yeah, so 300 doors, and we'll see.
Nice.
We'll see from there.
Awesome. Those are some great goals. Well, cool. Any like before we wrap up, is there anything that's been majorly impactful for you just over the last few years on your journey? If there was something you were maybe to share with like someone new, or just someone looking for like some new helpful or educational content they could digest that was really impactful for you.
Yeah, the well, I guess one for anybody interested in syndicating. So we did, from the day, you know, my business partner and I sat down and said we're going to do this, to closing on our 174th door. That was a year almost to the day. And one thing that, you know, that I did that was super helpful was, one, I mean, I listen to as many podcasts as I could. I try to talk with, as many people as I can. I never like, hold on, let me rephrase. I always try to be one of the dumber people in the room, right? I have no problem being that, filling that role. I thrive in that role. I ask thousands of questions, and then I follow up and I ask more questions. And I just, it was really helpful for me. And a book recommendation I got, rewind, December, I guess it would have been December 2020 when it first started, there's a book by Matt Fairless. I can't remember his name. Either way, it's called The Best Apartment Syndication Book Ever. It's a great name. It serves as that exact purpose.
Awesome. I'm looking it up right now. Joe Fairless.
Joe Fairless. That's who it is. Yeah.
Awesome.
Mixed up a couple names. But either way, so I use that book. He talks about market analysis. He talks about how to underwrite deals. He talks about what constitutes a deal, at least for him. Talks about, how to approach brokers, what to ask brokers, what to ask property management, what to ask legal, right? And as opposed to reading, and I read a couple other books too along the way, obviously, but as opposed to reading these real estate books like a novel or just cover to cover, just read them as you go along. Like, skim them, maybe cover to cover so you know what's coming up. But I used him as a textbook. When he has an email template to a broker asking a bunch of questions, I just literally typed up that email, changed the signature, kept the questions all the same, and made it applicable to whoever I was reaching out to. That's one of the beautiful things about real estate is, there are ways to reinvent the wheel, but you don't really have to get into the market, right? And it's been done successfully by a lot of different people. And most of these people are way smarter than I am, and I was able to do it, and we were able to do it within a year. And my whole education was done by reading, listening, and being the dumbest guy in the room.
Cool.
So
that's a really great point. I mean, that's one of the things I've kind of heard studying real estate is like, it doesn't require a genius. It requires a relentless attitude, a great attitude, and just the hunger to do the numbers and manage a lot of hats until you can start to divvy it off to people better than you, like these different things. And
exactly.
Being a people person, so that's awesome. That's a good book recommendation. I've actually never seen that one. So
yeah, it's phenomenal. It's very you have a lot of real estate books which are kind of like high level mindset type of books. This is very like nuts and bolts of, hey, when I'm looking at market analysis, go to this website, look at these things. When I'm doing, because that's how I learned to like analyze via the census, because that book told me how to do it. Go to these, pull these spreadsheets, you'll pull it, and then look at these types of numbers. And then same thing with interviewing brokers, interviewing property management, interviewing cost segregation analysts, interviewing legal teams. That's where I got my baseline level of questions. And then obviously I had my own questions just because it was my first time for everything. So then I tossed mine in there too. And you interview, 2 to 3 or 4 of people, from each industry to build out your team. And then you find your winning group.
Nice. Awesome, man. Well, if people wanted to reach out to you, get in touch with you, what's the best way to do that?
Yeah, so I'm on social media. You can reach out to me at Instagram, Morgan Hampel. Otherwise, our website is hammerandhampel.com. You can follow along our projects. You can subscribe to our newsletter. We send out quarterly newsletters, but then we'll also be posting upcoming deals that we have in case somebody wants to learn more. And then otherwise, you can just reach out to me directly by email, which is morgan@hammerandhampel.com.
Okay, awesome. We'll put that in the notes here below just for everyone so they can check that out. Well, I appreciate you doing this, and most importantly, doing it again. We had some technical issues on the first round, but you definitely shared a lot of great stuff in this one, even more than the first one. So I think it was definitely worth it, man. We appreciate it.
Awesome, Bob. I really appreciate you having me on.
All right, man. We'll talk soon.
All right. Yep, absolutely. Take care.